Hi guys, it's Wendy from Ask The Landlady. I'm here with all the tips and tricks to help you make a profit in real estate rentals. We're all here wanting to make money, honey, so I hope you're here too. In today's episode, I'm going to talk about interest rates. I'm actually going to explain them and talk about when should you lock in, because that's the big question on the table there. So everyone is waiting for the rates to drop, right? Hear it constantly. I'm going to wait till the rates come down. I'll buy when it hits 5. I'm going to wait till after the next Fed meeting. And look, I get it. Rates definitely matter. The difference between 6% mortgage and a 7% mortgage on a $350,000 house is over $200 a month. That's real money. It's money in your pocket. And I am not dismissing that at all. But here's what nobody tells you about waiting for the rates to come down. And that's that home prices out there in the markets have not come down. They've held. And in some markets, they've actually gone up. So the person who waited 6 months for a slightly better rate is now paying a slightly better rate on a more expensive house because that price went up. You know, rates come down, it's more people, buyers coming into market. The sellers are like, here's the house. There's still a low inventory compared to what it was pre-pandemic, so they can still jack up those prices and get it. So that's something that we all should be considering. The math could work out to be the exact same. Maybe you should buy now and shouldn't wait because that price is going to jump up when the rate goes down. That's the market we're in right now. So today I'm going to explain how mortgages actually work, what's happening with the rates right now, what adjustable rate mortgage versus fixed means in today's specific environment in 2026, and more importantly here, most importantly, when should you lock in that rate and see what that decision process looks like. So welcome back to Ask the Landlady. I'm so glad you're here. I hope you're checking out my books on Amazon because they're cheap. And they're the books that I wrote after doing this for 25 years and wish somebody would have handed this to me with my first duplex. It would have saved me so much trouble and time and energy. So it is, get it. And then shoot me your questions. That's what I'm here for. Ask the Landlady. So I'm going to start this episode by making a statement here, and that is that mortgage rates are genuinely confusing, okay? And part of that confusion is intentional. There's a lot of people in the mortgage industry that benefit from us investors, and they don't really want us to understand how these rates work, because if we did, we would shop harder, we would negotiate more, and we wouldn't accept that first number that we're getting from our banker, right? So my goal today is to give you that fundamental knowledge that makes you a dangerous mortgage borrower, right? In a good way. The borrower that asks better questions, that doesn't get taken advantage of, that doesn't accept their first offer, and that tries to time that rate decision with your eyes open rather than just, please hope this works out. I hope this stays. No, we don't want to do that. We want to have that knowledge. So let's dig into it. Let's start with the biggest misconception about the rates, and that is the Federal Reserve does not set your mortgage rate. Okay, we talk about the Fed rates, and they're like, oh, they set our mortgage rate. I know you keep hearing about the Fed raised rates, Fed cut rates, and that you suddenly made an assumption that somehow impacted your mortgage rate and going up and down accordingly. But that's not how this works. That's not how any of this works. And understanding that distinction is going to help you overall in terms of confusion. What the Federal Reserve sets is in the federal funds rate is the federal funds rate, which is the rate at which banks lend money to each other overnight, right? Well, it has to do with the banks and how they're doing it. That rate influences short-term borrowing costs, your credit card rate, your car loan, your home equity line of credit, right? It does have downstream effects on the mortgage rates, but it's not a direct lever, okay? It's the short term, the banks overnight. Your 30-year fixed mortgage rate is driven primarily by the 10-year treasury yield, okay? That's a bond that the US government sells to investors, okay? When we buy a lot of bonds, that's because we're nervous about stocks, right? Well, I'm going to move into bonds because I'm nervous about the stock market. And the yield on those bonds then goes down. And when the 10-year yield from the treasury goes down, mortgage rates tend to follow. And that's when investors flee the treasuries because we're all wanting to get into the stock market, the mortgage rates typically go up as well. So here's the practical takeaway on all this, because I know that's still very confusing, right? Anyone who tells you confidently that mortgage rates are going to do this because the Fed did that is oversimplifying things, right? And you're going to be, you guys are in the market that like I do. You're talking here, listening to all these get rich quick schemes, all these people saying build wealth in real estate, and they're all making these blanket statements, and it's not that direct or that clear. So that's why this strategy that I'm going to give you today is not about predicting rates. It's about decision making under uncertainty, because that's where we're at, people. It's a lot of uncertainty in our market. It's been that way since after the pandemic. This is nothing new for you guys. You know, we're dealing with it, we're living it, and we're going to continue to live it. So we might as well at least have the knowledge and the power to get through this together, making a profit, right? So let me give you some real-time pictures as of this week, because I'm filming this in April 2026. Okay, so it's fast moving. So by the time you watch this could all be bad news. But I still want to, it's still, the point is still the same about making decisions in uncertain rate risks, right? But as of today, Freddie Mac's weekly survey has the 30-year fixed mortgage rate averaging 6.23%. That's down from 6.3 the week before, and down from a year ago when it was 6.83. Rates are at their lowest level in the last 3 springs. Okay, so that's a real and significant improvement. On the 15-year fixed, we're looking around 5.65% this week. Okay, now, so what does that range mean going forward here into 2026? So we've seen probably the peak of that cycle, but not with certainty. So here's what the forecasters are saying. Fannie Mae is the most optimistic. Go Fannie. And they're projecting that 30 year is going to get close to 6% by the end of the year, possibly even 5.9. They're optimistic. Okay. Mortgage Bankers Association, they're a little more conservative folks, and they're saying 6.2 to 6.3 by the time we get going into 2027. Okay. So, but they're still all projecting that. But here's what I want you to know from those numbers is that we're still not, they're still just calculations. There's still a huge risk here. Who knows what will happen economically, politically, whatever, with that rate. I mean, so if you're banking on the fact that we're going to be at 5.9 by the end of the year, we could be at 8. This is a crazy market, guys. Crazy market. Plus the fact that we're going to talk about what happens with prices as those numbers come down, which I've already alluded to. So in 2022, if you locked in and rates moved a whole point against you, that was about $200 a month, right? So that's something that you want to consider going into all this too. So, okay, let's move on and talk about the adjustable rate mortgage, or an ARM, okay? People have gone underwater with these recently. It's been kind of problematic. There's been lawsuits. There's been some laws changed about that, because for years, these ARMs were the center of disaster. They were, the conventional wisdom was fixed rate, nonstop. You know what you're dealing with, right? If I know I'm paying 6.9%, I'm paying 6.9%. If I have an ARM, that 6.9% could go to 9, go to 11, could go to whatever. So that's scary. It could also go down. It could go in your favor. I've had ARMs over the years that were the best decisions I've ever made, because I bought it when the rates were like at 6.5, and then it went down to 3. Have at it. Fantastic. Money making years, right? So it's not so nuanced. So if you're under conventional wisdom that you should always have fixed, that's not necessarily the case right there. So a 5-1 ARM is going to give you fixed for 5 years, and then it's going to adjust based on the index rate after that. 7-1 ARM, same thing, but we're dealing with 7 years, and then it will adjust annually, not monthly, annually. So an initial rate on these ARMs, why they're attractive to you, is because they're typically lower than the 30 year. So if our 30 years at 6%, that ARM could be down at 5%, right? That's a significant difference. So when would that make sense this year? And I have a few scenarios where it might be worth you looking into an ARM versus the fixed rate. So scenario 1 is if you don't plan to stay in the home long term, right? If you're in a career path, or who knows, you have aging parents you're watching, or you have a goal to maybe retire or become an empty nester soon, whatever, that adjustable rate might make sense to you. The average American moves up or refinances every 7 to 10 years. So if you're buying a starter home and you plan to get out of it, you're going to be out of it before the adjustable rate even begins. So why not take that lower interest rate that's locked in for 5 to 7 years? You've captured that and you don't have to worry about it. So that's scenario number one. So hold on. Scenario two is that you have a clear refinancing plan and the financial flexibility to execute it. So if rates do come down over the next 2-3 years, then you have a clear plan where you could actually refinance that and lock into a 30-year rate, and you have the money to pay those fees and do those types of things. Scenario three is that you have a high income and financial flexibility. That's not going to cause you hardship if it does change on you. You can weather the storm if it goes up a little bit and then comes back down, hopefully, right? So if you're just barely making it on that rental property with your adjustable rate, that's a red flag. That's when you don't want to do it. That's too risky for you, because if it goes up in 5 years and you haven't significantly increased your income or your risk ratio or whatever, then that could become problematic. And we saw a lot of people recently that had those arms that were forced to sell. And I don't want that to happen to you. You want to hold your property, be a holder. You don't sell your money machine, baby. As long as you're cash flowing, and you keep rinse, wash, rinse, repeat on your rental and ride it out to the end of time. That's what you're going to do. So let's talk about rate locks, because that's where a lot of buyers make mistakes that actually cost real money. A rate lock is exactly what it sounds like. Your lender will guarantee a specific interest rate for a set window of time, usually to allow you to close. Like, I'm locking in that rate. We're going to close in 45 days, right? If the rates go up before you close, you're protected. You're still going to get that locked rate. And if they go down, you're probably still going to get that locked rate, unless you have a specific provision in your lock agreement, which you don't get what you deserve, you get what you negotiate, so you might as well ask for it. Ask for that locked rate. If it goes down by a percent, then I want to get that. If not, whatever, we'll stay there. So here's where a lot of people go wrong. A lot of people say, well, I was quoted this rate, and why am I paying a different rate when I close? That's a rate quote. A rate quote is not a rate lock. Okay. You can be quoted a rate by the lender, and that number is essentially meaningless until you formally lock it in. Rates can change daily. In this market, they can. So if you get a rate you like, you lock it in. Locking too early can waste money. If your closing is 90 days out, that could be problematic. That rate could change and go down. So this is where it's difficult to try to figure out what to do. If you're within 30 to 45 days, lock it in. Okay. Things I don't think are going to change that much. See if you can get a provision that if it goes down significantly by like a point or something, that they will change it. They'll probably let you do that because they're not going to think that's going to happen. But if it only goes down quarter or a half, you're not going to get it. But if you're comfortable with today's rate, you're making money on this today's rate, go ahead and lock that in for the 30 to 45 days. If you're 60 or more out, I would not lock that in, because it looks like we are going to trend a little lower. And I would consider waiting in that. And you could have a clear trigger number, like it hits 6%, I'm going to lock it in. That makes sense. And even Fannie Mae said it's not going to get 6 till the end of the year. So if you're looking at a closing right now and and it's still up, you could say, I'm going to wait. If it when it hits 6, banker, I'll lock it in that day. Maybe that could be your real strategy. If you get a rate right now below 5.9% and you're confident about your finances, lock it in. That's pretty a rare number, and we don't have a forecast going any lower than that. So lock it in. That's totally what I would do with that. So, okay. So I'm going to address something else that people say a lot of times about interest rates and about locking things in, is the buy now, refi later strategy. Okay. I'm going to buy it now and it's no problem. I'll refinance it later when the rates go down. I'm sure you've heard it. I'm sure your real estate agent has said it. Your mortgage broker has said it. And is that good advice? Sometimes. Yeah. And sometimes No. And what it comes down to is your break even point. So here's how it works. Refinancing is not free. Okay. It costs money when you refinance. You're going to pay closing costs again, typically 2 to 3% of the loan amount. So on a $350,000 loan, that's $7,000 to $10,000, right? Those costs have to be recovered through your monthly savings. If not, it's not worth it. Why would you do it? Why would you pay $10,000 to not get any benefit, right? So if it drops your rate by half a point and saves you $100 a month, and your closing costs are, say, $8,000, your break even point is 80 months. Okay, that's 6.5 years. If you plan to stay in the home longer than that, the refinance is worth it. But if you're going to maybe sell this in 3 years, you would have paid $8,000 to save $3,600 in payments before selling. That doesn't make sense. That's a loss. That's boo. We don't do losses. When I don't Ask the Landlady only does profits when they want to do up. So the only way this buy now and refinance it later works is if certain conditions are met. One, plan to keep this home or this rental property long enough to recoup any refinance costs. Okay. Two, the rates drop enough to produce a meaningful monthly savings, right? Not just 0.25% or something, a meaningful point decrease that actually generates more profit. So like I said, it's 5.9% maybe by the end of the year. That's not a lot of savings from where we are now, right? 0.25 point. So the math isn't going to work unless you go at least half a point, probably a full point. And your other condition is if you're buying the property right at the right, correct, at a price that makes sense to you, you're not overpaying for this property, then that could make sense for you to do that. If you're overpaying now, don't count on the buy now, refinance later, because that might not happen. The math may still not work. So if the math doesn't work now, don't do it. Don't do it because you're taking on way too much risk. So now it does have its place, and some of you investors are going to say, "Hey, it worked for me. I bought in 2023 when it was 7.5%." Absolutely. Yes, I would refinance 7.5% down to 6%. That's a done deal. You worked out well, especially if that was the right price point then. It's even a better price point now. Totally worth that strategy. So let me give you my practical rate decision framework. Number one, can you afford the payment at today's rate, at today's price? Okay, that has to happen. All this other stuff is just noise and problematic. You need to be able to afford it now at today's rate, today's price. Okay. Certainly you can think about things about how long you plan to stay, because that's going to determine whether or not you might take advantage of that adjustable rate mortgage. Okay. Three, what's your budget tolerance? Would a $300 a month increase break you, or is there wiggle room in that rent for you to still weather that? That's something that only you know by your numbers. Okay. Four, how close are you to closing? If you're going to not close for 3 months, don't lock in yet. If you're closing in 30 days, okay, I've locked in. It's not really going to mean much difference to you. And is your property worth buying, again, at today's rate and price? That's the number one thing. Is it going to appreciate based on your values that you have done? So before I close this one out, I'm going to answer a couple questions that people have asked me in DMs and some things through Ask the Landlady. And one is about mortgage points. What are mortgage points, and should I pay them? Okay. A point is equal to 1% of your loan amount. So paying a point up front on a $350,000 loan would be $3,500. Typically buys your rate down by a 0.25% point. So like today's, like refinancing, there's a break-even calculation that might tell you if that's going to be worth it or not. If the break-even is 4 years, then, and you're staying in this house forever, or you're holding this house forever, your kid's going to live in it, and then you're going to rent it out to other people, whatever, then it might make sense. If you're not sure, this is a new market for you, I would be cautious. I would not pay points to get a better rate at this time. Number two question somebody asked was about a rate buy down from a builder or a seller. And that's a negotiation tool. Usually like builders, when they're building these spec homes kind of thing, they'll temporarily reduce your interest rate for the first couple years of the loan. So a 2-1 buy down means you get a 2% lower in year one, 1% lower in year two, and then you get the full rate in year three. That can genuinely help your cash flow in those early years. And those are some good incentives. But again, you need to be paying attention to that year 3. If that's going to make a significant jump in the inability to pay the mortgage and you don't think the rents are going to go up to justify that, then I definitely would not do that. So number 3, somebody said, I work with this lender all the time, and they quoted me a rate, but somebody else I asked about that I don't usually work with offered a better rate. Should I switch because I'm trying to stay loyal to this bank? Please, no loyalty here, baby. You go where the money goes. You take what you can take. You get what you can get. The days of loyalty, there's no pension plans for our employees anymore. People are moving around all the time. You got to do what's best for the deal. You got to do what's best for you. You got to do what's best for that house. You got to do what's best for your tenant. You can afford to do better improvements if you have a better rate, right? So you always, always, always shop around, okay? And your first quote is almost never your best quote. And you can't go back to your banker that you love to work with and say, I'd love to work with you, but the credit union down the street's giving me a better 0.5% down. Can you do that? Can you match that? And they understand if you can't. Don't be a people pleaser. You cannot be a people pleaser, be a landlord. Okay. So knock that self out of you. So anyway, I hope that this has made you think about mortgage rates in a different light, maybe gave you some information you didn't have. Tell me what rate you're getting right now. I'd love to hear about it. Do you think they're going to go up or down? Love to hear from you. Shoot me something in the comment. And as always, hit subscribe. That way we can keep going on this journey together, keep talking about real estate and about how to make a profit and build wealth by being a landlord. Thank you. And I hope you have a great day.